Welcome to the deep dive. If you've been paying attention, really paying attention, to the signals coming out of Washington and Beijing just over the last few weeks, well, you know that the economic relationship between these two superpowers, it's clearly past some kind of critical inflection point.
Absolutely. I think many of us maybe hoped is the right word, that the U.S. China trade war, the tariffs, the endless posturing, that was mostly behind us, this sort of relic of 2018, 2019 maybe?
Something that had kind of settled into this, well, let's call it an uneasy status quo, right? A kind of baseline tension we'd all just gotten used to.
That status quo is definitively broken now.
Yeah.
What really emerged in late 2025,
Yeah.
specifically October, it isn't just a replay of those old fights over trade deficits or market access. No, this is something new. We're calling it Trade War 2.0.
Trade War 2.0. And it feels different because it is different, right? It seems much sharper, faster, more targeted.
Exactly. It's strategically focused. It's moving at, frankly, a blistering speed. And it's targeting the absolute fundamental inputs of the next technological age. We're talking about the building blocks.
And our source material, the stuff we've been digging into for this, it frames this shift with, well, incredible clarity, I think. The fight isn't just about whether we buy more soybeans or, fewer widgets anymore.
No, not at all.
Yeah.
It feels like a deliberate, very calculated move on this grand chessboard of global economic control.
We often talk about that phrase, the Thucydides Trap, don't we? The idea that conflict is almost inevitable when a rising power challenges an established one.
And the thesis here, what the sources are suggesting, is that it's manifesting right now, but not necessarily as kinetic war, not missiles over Taiwan, at least not yet. It's playing out as this prolonged, really sophisticated economic confrontation.
A war of tariffs instead of troops, as one source put it, which is quite a phrase.
It is. And what makes this period, specifically these events in October 2025, what makes it fundamentally different from, say, 2018? It's that the line, the distinction between economic policy and national security policy, it's functionally vanished. It's gone.
So we're not just debating market access anymore. It's not about getting U.S. cars into China or Chinese electronics into the U.S. cheaper.
No, we are fighting over who controls the actual infrastructure. I mean, the foundational atoms, the critical minerals and the advanced algorithms, the AI chips, the software ecosystems, the things that will define the entire 21st century industrial age.
Okay, so that's the new battlefield. And it's defined by these strategic weapons, economic weapons, designed to cripple a rival's ability to develop long-term.
That's the core of it. On the U.S. side, you see the expansion, the tightening of semiconductor and AI chip controls, trying to uphold the high ground, the processing power.
The brains of the operation, so to speak.
Exactly. And then on China's side, it's the strategic weaponization of critical minerals. Specifically, and I'll get into this, rare earth elements. These things form the base material layer of pretty much every single piece of modern technology. Your phone, my laptop, but also fighter jets and wind turbines.
The bones and sinews, maybe, if the chips are the brain.
That's a good way to put it.
Yeah.
It's a direct counter. So our mission in this deep dive, for you listening, is to really unpack this dramatic escalation. We're going to try and make sense of it.
Right. We need to look at the precise tit-for-tat timeline. What actually happened this past month? Why did it happen now?
And we absolutely need to show exactly why these rare earths are being called China's, well, some are calling it their nuclear option in economic terms.
And connect that directly to the risk this tension poses to, well, what feels like an incredibly overheated global AI investment boom. That whole AI froth idea.
Huge implications there. And then there's the legal side. This whole fight is tangled up in a massive legal challenge about tariffs, about presidential power. That's actually sitting before the U.S. Supreme Court right now.
Okay, so it's a complex picture. Minerals, chips, AI, hype, constitutional law. It's all connected.
It really is. But understanding these pieces, how they fit together, it's absolutely essential if you want to grasp the economic architecture, the fault lines, really, of the coming decade. It's that important.
Okay, let's unpack this escalation then, starting with the immediate backstory. Because things had seemed to stabilize, didn't they? At least for a little while earlier this year.
They did, relatively speaking. We had that brief 90-day tariff freeze back in mid-2025, and that, it led a lot of people to hope, maybe even believe, that the worst of the trade friction was actually over.
A sigh of relief, perhaps prematurely. So what was the flashpoint? What specifically happened to shatter that, well, pretty fragile calm?
Well, the calm was always conditional, wasn't it? Highly conditional. We'd seen U.S. tariffs reduced sort of provisionally down to around 30% on average. China's corresponding tariffs were down to about 10%.
Which sounds like progress. And there was talk of a summit, right? A potential meeting between Xi and Trump to maybe finalize some kind of deal?
There was talk, yes. Expectations were raised. But the fundamental disagreements, the core issues, they remained completely unresolved beneath the surface. China, for instance, showed no sign of fully relinquishing state control over its advanced technology exports or relaxing cybersecurity rules.
In the U.S.
And the U.S. wasn't prepared to drop its restrictions targeting key Chinese AI firms or semiconductor companies. The national security concerns on both sides hadn't gone away.
Yeah.
So it's more of a pause than a resolution.
Got it. So that fragile pause held until late September, early October. And that's when the escalation really kicked off again. And the first move, according to the sources, came from the U.S. side.
That's right. The administration, picking up the threads of the America First agenda, moved decisively. They didn't just reinstate the previous tariffs, they reimposed and dramatically expanded them.
Expanded how much? We talk big numbers here.
We are, reaching as high as 145% on certain very specific, high-profile sectors, things clearly targeted.
Like what?
We're talking about electric vehicles, steel, aluminum, and a pretty wide array of semiconductor components, inputs needed for manufacturing here.
Okay, 145%, that's not a subtle signal. What was the justification given?
Officially, national security, protecting nascent domestic industries, particularly in EVs and strategic metals, from, quote, unfair Chinese competition. But the sources also note something else. The clear threat of this massive increase, as it was termed, effectively shut down any realistic prospect of further high-level negotiation.
It killed the summit hopes.
Pretty much. The message seemed to be, negotiations are over. This is the new policy reality. Accept it. It was a very hard line.
And China's reaction? Predictably strong, I assume.
Immediate and strong, yes. Beijing publicly accused the U.S. of economic bullying. That language came right after the new U.S. chip restrictions were announced, which directly targeted some of their most advanced AI firms.
So the chip restrictions were maybe the final straw on top of the tariffs?
It seems that way. But China's retaliation wasn't just, slapping equivalent tariffs on U.S. goods. That's kind of trade war 1.0 thinking.
Right, that's the old playbook.
Exactly. Their response this time was immediate, yes, but also fundamentally strategic, calculated. They hit back directly at the foundation of the U.S. high-tech industry, where it's perceived to be most vulnerable.
So this is where the symmetry comes in. If the U.S. targets the brain, the AI chips,
then China targets the bones, the critical minerals needed to make everything, including those chips and the systems they run on.
Okay, let's walk through that tit-for-tat timeline in October 2025, because the speed and the deliberate mirroring are, well, striking.
They really are. First, almost immediately after the U.S. moves, Beijing announced a major new restriction, a really significant one. They stated that any product containing more than 0.1% Chinese rare earth materials by weight would now require explicit government approval for export.
0.1%, that sounds tiny.
Yeah.
But incredibly broad.
It is. And that threshold, that 0.1%, that's a crucial detail. It's almost legally aggressive in its formulation. It effectively asserts a kind of extraterritorial control over global supply chains.
Okay, unpack that. What does 0.1% mean in practice for, say, a company not even based in China or the U.S.?
Okay, think of it like this. Remember how the U.S. applied its chip export rules, the foreign direct product rule, to companies like Taiwan's TSMC, even though they weren't U.S. companies?
Right, if they use U.S. technology or software in their process.
Precisely. China seems to be doing something very similar here, but with materials. So let's imagine a German car manufacturer. They're building an electric motor for one of their new EVs. That motor probably uses a high-performance permanent magnet, like a neodymium iron boron or NdFeB magnet. Very common, very powerful.
Needed for the motor's efficiency.
Exactly.
Yeah.
Now, let's say the company that made that magnet, maybe a company in Japan or Vietnam, used neodymium or dysprosium that was processed in China. Even if the final car is assembled in, say, Mexico, that specific motor, or maybe even the whole car, could now potentially require an export license from Beijing. Why? Because somewhere deep in its supply chain, that 0.1% Chinese rare earth content threshold was crossed.
Wow. So it pushes the compliance burden way down the chain. Companies need to trace the origin of every tiny component's raw materials.
It creates potentially massive traceability and compliance nightmares for multinational corporations. You have to audit your entire supply chain down to the raw material processing stage. It effectively extends China's regulatory power globally.
It really is an almost perfect mirror of the U.S. chip rule, but flipped materials instead of intellectual property or technology.
It seems designed that way, deliberately symmetrical. And this wasn't the only move. Beijing coupled the sweeping materials control with more traditional sanctions, too.
Right, the company blacklists.
Exactly. The U.S. added 14 Chinese companies to its entity list almost immediately. Many of these were involved in things like AI hardware, quantum computing research, advanced materials, strategic sectors.
Then China's response.
Swift and reciprocal. They added 16 U.S. companies to their own unreliable entity list. And significantly, many of those U.S. companies were deeply tied to defense contracts, aerospace, specialized components, that sort of thing.
Sending a clear signal about defense supply chains.
A very clear signal.
Hmm.
And then came the perhaps less glamorous but still highly disruptive move, the logistical skirmish.
The port fees affecting actual physical trade.
That's right. China imposed new port fees on all U.S.-owned, U.S.-operated, or U.S.-flagged vessels, calling it Chinese ports. This kicked in really quickly, effective October 14th.
And this mirrored something the U.S. had proposed earlier.
Yes, it was a clear, calculated mirroring of earlier U.S. proposals that had targeted Chinese shipping lines. So again, that tit-for-tat dynamic.
How much trade does this actually affect? And what's the cost?
This logistical friction, these new fees, they affect a significant chunk of U.S.-China maritime trade estimates are around 60%. And the costs aren't trivial. Depending on the vessel size and cargo, we're talking maybe $50,000 to $200,000 per vessel per call.
And who pays that? It gets passed on, presumably.
Inevitably, those costs will ripple through the supply chain and ultimately land on consumers in the form of, well, just general price inflation on imported goods.
Yeah.
Another layer of cost pressure.
So looking at this whole sequence, the massive tariffs, the entity list, the court fees, and crucially, that rare earth control rule, we've definitively moved beyond just arguing about tariffs, haven't we?
Absolutely. And this is where that core analysis we touched on earlier, the distinction between controls and tariffs, really comes into sharp focus. It's critical to understand this difference.
Okay, break that down. Tariffs versus controls.
Tariffs, fundamentally, are about prices. They act like a tax. They make imported goods more expensive. They're a blunt instrument intended to shift buying patterns or protect domestic industry, but ultimately, they just change the cost calculation.
And we mentioned the cost. The sources estimate maybe $1,200, $1,500 a year in higher expenses for the average American household if these big tariffs stick.
That's the kind of impact tariffs have. But controls like the U.S. bans on selling advanced chips to China or China's new rare earth export licensing system controls are different. They shape possibility.
Possibility? How so?
They determine what industries can even exist. They determine what technological pathways a nation or even a company can pursue. If you can't get the essential chip, you can't build the AI data center. If you can't get the specific processed rare earth mineral, you can't build the advanced motor or the missile guidance system. It's not about price, it's about availability. Full stop.
So the line between economic policy and national security policy
has completely vanished. It's gone. Traditional economic tools like export licenses or import duties are now being wielded explicitly as instruments of national deterrence. National security priorities are overriding economic efficiency concerns. That's the essence of Trade War 2.0.
And the market reaction to this realization in October, it was immediate and, frankly, brutal.
Stunningly so. We've had trade tensions bubbling for years, right?
Right.
So you might ask, why was the immediate market shockwave this time so profound? We saw global markets lose roughly $1.65 trillion in market capitalization in a single day.
$1.65 trillion in a day. Didn't investors already sort of price in the risk of tariffs coming back? Wasn't that expected to some degree?
That is the absolutely critical question. And the answer seems to be yes. The market had, to some extent, priced in the risk of tariffs. Tariffs are inflationary, they hurt margins, but they're manageable in a way. Companies can adjust sourcing, pass on costs.
But they hadn't priced in the controls.
Exactly. They hadn't fully priced in the risk of controls that directly threaten the physical supply chains for the hottest, most market-moving sectors. AI and defense, and by extension, things like EVs.
And the indices reflected that.
Clearly. The Dow Jones fell over 800 points, about 1.14%. The S&P 500 dropped 1.7%. But look at the NASDAQ, it tumbled 2.3%. That was its steepest fall in months. And what led the fall? Semiconductor stocks and EV stocks.
The exact sectors targeted by the tariffs and the controls.
Precisely. The market realization seemed to be twofold. First, this conflict isn't temporary anymore. It's structural. It's probably permanent. Any lingering hope for a real détente, a return to the pre-2018 status quo, that was shattered.
And second,
Second, the threat is now kinetic, so to speak, on the supply chain itself. It's not just that components might get more expensive. It's that the government might simply say, no, you cannot have them, full stop. Either the U.S. government blocking chip exports or the Chinese government blocking rare earth exports.
that level of fundamental uncertainty.
Is poison for markets. Capital flees that kind of uncertainty. It seeks safety.
And we saw that flight to safety, didn't we? Money flowing into U.S. Treasuries, the classic safe haven, but also, interestingly, into things like Bitcoin.
Yeah, it's an unusual combination,
Mm-hmm.
but it reflects that immediate desire to get out of assets perceived as vulnerable to this deep geopolitical rift and supply chain risk. Get out of complex, interconnected global equity.
So that kind of immediate massive shockwave, the sheer scale of the financial reaction, it signals that investors see this not just as political theater, but as potential structural damage to the global economic system.
That seems to be the message the markets were sending. Loud and clear. This isn't just noise. It's a fundamental shift.
Okay, let's pivot now and dig much deeper into the specific leverage that China holds in this fight. Rare earth elements, REEs, it's a term we hear thrown around a lot, especially in these trade discussions.
Often without much context.
Right. And I think most people, myself included, sometimes don't fully grasp just how fundamentally these, 17 specific metals on the periodic table, how much they underpin not just modern consumer tech, but really military superiority and the green energy transition. What exactly are we talking about when we say rare earths?
Well, first, the name is a bit of a misnomer. They're not actually all that rare in terms of crustal abundance. Some are more common than lead or copper.
Oh, interesting. So why the name?
It comes from the fact that they're rarely found in economically concentrated, easy-to-mine deposits, like, say, a big vein of gold. They tend to be widely dispersed, often mixed together, and chemically very similar to each other, which makes separating them the real challenge.
Okay, so it's the processing that's the hard part, not finding them.
Exactly. But what makes these 17 elements, metals like neodymium, dysprosium, terbium, yttrium, lanthanum, cerium, so critical is their unique atomic structures. These give them incredible magnetic, luminescent, and catalytic properties.
Properties you can't easily replicate.
Pretty much. You cannot get the same performance, the same efficiency, the same unique characteristics in high-performance applications using other, more common elements. They are functionally indispensable for certain key technologies.
Okay, let's talk specifics then. Give us some concrete, maybe memorable examples of where this RE dependence really matters, especially in those strategic sectors that define national power today.
Right. Let's start with the green energy transition, which is a huge global priority. For EVs and renewables, rare earths are absolutely mandatory.
How so?
The most powerful permanent magnets known are made with neodymium, iron, and boron, the NdFeV magnets we mentioned. They also often add dysprosium or terbium to improve performance at high temperatures. These magnets are essential for the high-efficiency traction motors in electric cars. They provide the power density needed to make EVs practical.
So without these specific rare earth magnets, EVs wouldn't perform as well or be as affordable.
Both. You need larger, heavier, less efficient motors, which impacts range, cost, everything. And it's the same for wind power, those massive offshore wind turbines. Many use direct drive generators that rely heavily on these powerful rare earth magnets to convert wind into electricity efficiently. Again, the power density is key.
Okay, so the energy transition is heavily reliant, but you mentioned the real urgency often comes from the defense sector.
Absolutely. This is where the national security implications become incredibly stark. For modern military hardware, REEs are simply non-negotiable.
In what kinds of systems?
We're talking radar and sonar systems, which use rare earths for signal processing and powerful emitters. Precision navigation systems, like GPS receivers, missile guidance fins and control systems rely on compact, powerful actuators made with rare earth magnets. Lasers for targeting and communication. Even specialized alloys for jet engines and armored vehicles use them for strength and heat resistance.
It sounds like they're embedded everywhere in advanced weaponry.
They are. And the sources provide a figure that really drives this dependence home, makes it visceral. An F-35 fighter jet, arguably the pinnacle of current Western air power,
Yeah.
requires 417 kilograms of rare earth elements.
417 kilos, that's nearly half a ton per plane.
Per plane. And that's not just, a tiny bit in the cockpit displays. It's embedded throughout the aircraft. In the advanced sensors, the electronic warfare systems, the stealth coatings that absorb radar signals, the high-temperature engine components, and crucially, in the guidance systems that steer its bombs and missiles accurately.
So, if the supply of the specific processed rare earths were cut off,
A denial of supply, or even just a significant restriction, could fundamentally undermine the entire industrial capacity of the U.S. defense sector.
Yeah.
You couldn't build your most advanced platforms at the required rate. You might be forced to revert to producing older, less efficient, less capable systems. At a time of rising global tension, that's a terrifying prospect.
it really is an astonishing dependency for, as you said, the world's largest military power to have on its chief strategic rival. But let's get back to that crucial point you made earlier. The sources emphasize this isn't really a fight about where the ore is mined. It's about the processing. That's the strategic choke point.
That is the absolute key, and it's so often misunderstood in reporting on this. The raw ore itself, the mining stage, it's actually relatively dispersed globally. The U.S. has reserves, like the Mountain Pass mine in California. Australia is a major producer. Vietnam, Brazil, India, Russia, they all have significant deposits.
So the raw material isn't the issue.
Not primarily. The dominance, the chokehold, lies squarely in the processing and separation stage. This is where China has built an overwhelming near-monopoly position. They control nearly 90% of global REE processing capacity.
90%.
And related to that, they also manufacture the vast majority of the world's finished rare earth permanent magnets, those critical NdFeB magnets. So they control the crucial midstream and a key downstream product.
Why? Why did the West essentially let this happen? If these materials are so vital, why did we offshore almost all the processing capability? What makes this step so prohibitive for us to recapture?
It boils down to two main factors: technical difficulty and environmental cost. The core processing step is incredibly complex. It typically involves solvent extraction.
Okay, what's that?
It's a multi-stage chemical process using acids and solvents to separate the 17 different rare earth elements, which, remember, are chemically very similar, from each other and from other unwanted elements often found in the ore, like thorium or uranium, which can be radioactive.
Sounds messy.
It's incredibly messy, requires enormous amounts of energy. It uses large volumes of toxic chemicals and acidic effluents that need careful treatment. And crucially, it generates massive amounts of waste tailings, including low-level radioactive waste, which needs to be stored safely, basically forever. Think huge waste ponds.
So high cost, high environmental burden.
Exactly. For decades, starting maybe in the 80s and 90s, Western countries with stricter environmental regulations found it increasingly difficult and expensive to do this profitably. So they effectively offshored this dirty, complex, low-margin middle stage of the supply chain.
And China was willing to take it on.
China saw a strategic opportunity. They heavily subsidized the industry. They built up the expertise. They were willing to absorb the enormous environmental costs and health impacts, frankly, associated with this processing to achieve dominance. It was a long-term strategic industrial policy decision.
They paid the environmental price to gain the strategic leverage.
That's a fair summary. And now, today, it is simply not commercially viable for a private Western company to just decide to build a large-scale rare earth separation plant without massive multi-decade state support subsidies, loan guarantees, help with permitting to offset those huge environmental compliance costs, and the operational expenses compared to the subsidized Chinese competitors.
So China's new October 2025 export controls the ones requiring licenses based on that 0.1% threshold. They basically formalize this leverage. They turn that processing dominance built over decades into a tangible weapon.
Precisely. It's turning a de facto market dominance into a de jure instrument of state power. The new controls require exporters to declare the specific end use and end user of the materials.
And the implication is that some applications will be denied.
The clear signaling, according to analysts interpreting these moves, is automatic denials for defense-related uses and potentially for components going into advanced AI hardware projects outside of China. They might approve exports for consumer electronics, maybe basic industrial uses, but strategic applications, likely blocked.
So the goal is explicit then. Leverage China's control over the minerals at the base of the tech stack.
To directly counter the U.S. controls over the advanced chips at the top of the tech stack.
It really is that strategic symmetry we keep coming back to. The U.S. blocks the brain, the chips. China blocks the bones and sinews the essential minerals and magnets.
It's an architecture of, mutually assured disruption, perhaps. Neither side can fully disable the other without risking severe blowback. The U.S. can certainly hurt China's climb towards technological leadership in areas like AI, no doubt about that.
But in retaliation,
China can hold America's high-tech industrial base, and more acutely, its military readiness, hostage. This dependency, especially for defense, is incredibly dangerous. If this conflict drags on, if these controls bite hard, China could potentially slow U.S. production of critical munitions, guidance systems, advanced platforms.
just as global demand might be surging, thinking about support for allies like Ukraine or tensions elsewhere.
Exactly. It exposes a fundamental vulnerability at a moment of heightened geopolitical risk. It could directly impact America's ability to project power and support its allies.
So the lesson here seems crystal clear. Regardless of what happens with the tariffs, whether they go up or down, whether the courts strike them down or not, the strategic necessity for the U.S. and its allies to build a secure, alternative mine-to-magnet supply chain outside China seems absolutely paramount now. This isn't just a nice-to-have for economic efficiency.
No, it's transitioned fully into a national security mandate, and it's a massive undertaking. We're talking about a 5 to 7 year project, minimum, according to industry estimates.
Maybe longer.
5 to 7 years, and it requires
Heavy, sustained state investment. Huge subsidies, not just for finding and opening new mines, although that's part of it. The real money, the real focus, has to be directed squarely at those bottleneck stages we discussed. Building new solvent extraction and separation facilities, and crucially, fostering the domestic or allied production of the finished rare earth permanent magnets. That's where the current gap is largest.
So just finding more ore in the ground in Australia or the U.S. isn't enough. You have to replicate the entire complex, costly processing chain. You have to replicate the hardest parts of the chain. The West has to consciously decide to accept the environmental challenges and the higher commercial costs associated with building this entire processing infrastructure domestically, or only with trusted, secure partners. It's a fundamental strategic reshoring effort.
Okay, it's easy to frame this conflict, this trade war 2.0, in terms of, big military platforms like F-35s or bulk trade flows of steel and soybeans. But perhaps the most immediate and potentially most devastating victim of this escalating supply chain friction could be the global artificial intelligence sector. We're talking about that multi-trillion-dollar investment boom, what some are calling the AI froth, that has basically carried global stock markets over the past year or so. Let's try and connect the dots directly. How does this geopolitical collision between U.S. chip controls and Chinese mineral controls threaten the AI sector specifically?
This is where the geopolitical tension becomes incredibly acute, commercially speaking, because the current almost dizzying scale of investment flowing into AI, building data centers, buying GPUs, funding startups, it's all predicated really on two incredibly fragile assumptions.
Okay, what are they?
First, that the highly specialized hardware needed, particularly advanced GPUs from companies like NVIDIA and AMD, will be readily available and continue to get cheaper and more powerful following historical trends. And second, that the complex global supply chains required to manufacture and deliver that hardware will remain perfectly stable and efficient.
And this conflict directly attacks both of those assumptions.
Directly. The moment you inject serious geopolitical risk right at the level of core inputs, whether it's the rare earths needed for components within the GPUs, or the cooling systems for the data centers, or the advanced chips themselves being subject to export bans, that entire incredibly leveraged and maybe fragile edifice of AI investment is threatened at its foundations.
And the sources we looked at provide some pretty compelling evidence that this sector was already showing signs of, well, dangerous overheating even before this latest October escalation. What are the characteristics that define this specific AI froth?
Well, the sheer scale of capital pouring in is just unprecedented. We're seeing AI-related capital expenditure CapEx, basically spending on infrastructure like servers and data centers, absolutely explode. It surpassed $368 billion globally this year alone.
$368 billion just on AI infrastructure build-out.
In a single year. And to put that number in perspective, in the U.S. context, that represents nearly half of all non-residential business investment this year.
Half. Half of all investment in factories, equipment, software, everything outside of housing is going into AI.
Roughly half, yes. It's a staggering concentration of capital. We are building the foundational infrastructure for this anticipated AI revolution at a furious, historically unprecedented pace.
That sounds impressive, but also, maybe, excessive. Is there a mismatch between the spending and the actual returns being generated yet?
That's where the froth argument comes in, and it should be triggering some serious alarm bells. Many analysts, particularly those tracking enterprise tech spending and actual revenue generation, project a potential $800 billion gap between the cumulative investment currently pouring into AI infrastructure and the projected revenue streams needed to actually justify those massive costs by the year 2030.
An $800 billion gap between investment and plausible returns. How does that compare to, say, previous tech bubbles?
That projection, which comes from firms tracking how enterprises are actually using and paying for AI versus just investing and building it, suggests either massive future overcapacity is being built or, more worryingly, there's systematic overvaluation happening right now. When you look back at historical bubbles like the dot-com era, companies had huge market caps but often zero revenue. The disparity here between the capital invested up front and the currently realized operational returns from AI applications might actually be larger in scale relative to the money going in.
Okay, so where is all this investment capital actually coming from? Is it based on solid fundamentals? The sources describe something concerning called circular funding loops. Can you break down what that means for our listener?
Yeah, this is a classic hallmark of a speculative boom, and it's worrying.
Hmm.
Here's how it works, in a simplified way. A venture capital firm, let's call them VC Fund 1, invests in Startup A, an AI company. They give Startup A a very high private valuation, maybe $500 million, based almost entirely on its future potential in AI, not on its current revenue, which might be tiny or non-existent.
Okay, standard VC practice for promising tech.
To a degree. But here's the loop. Startup A then takes a massive chunk of that cash, just raised often 80% or more, and immediately spends it on buying incredibly expensive GPUs from, say, NVIDIA or AMD. They need the computing power to train their models.
Right, they need the hardware.
But this massive concentrated purchasing by hundreds of startups like Startup A drives up the demand for those GPUs and consequently their price and the profits of the chip makers. Now, another VC firm, Fund 2, looks at the market. They see Startup A raised money at a high valuation and is buying lots of hardware. So Fund 2 decides to fund Startup B at an even higher valuation, maybe $1 billion.
Why higher?
They justify it partly by saying, well, Startup A is the market leader, valued at $500 million, and Startup B needs to compete. So it needs even more computing power, which means buying even more expensive GPUs. It becomes this self-reinforcing feedback loop.
So inflated paper valuations from VCs are directly funding massive hardware purchases.
Which in turn drives up the revenue and stock price of the hardware makers.
Yeah.
Which then further encourages VCs to pour more money into more startups at even higher valuations because the market seems so hot. The money flows in a circle, largely detached from the actual economic value being created by the AI applications themselves at this stage.
And this whole structure is incredibly vulnerable to any disruption in that hardware supply chain, right? Especially since this hardware isn't like, say, laying fiber optic cables during the dot-com boom, which had lasting value.
Exactly. That's a critical difference. AI hardware, particularly GPUs used for training the biggest models, depreciates incredibly rapidly. Its useful lifespan is maybe only 2 to 3 years before it's technologically obsolete or needs replacing.
2 to 3 years. That's incredibly fast obsolescence.
It is. It means these massive, expensive data centers require constant, rapid, and costly upgrades just to stay competitive. You can't just build it once and coast. Add to that, the immense energy consumption estimates are now suggesting that AI data centers globally could soon demand as much electricity as a major industrialized nation like Japan or India.
Wow. The power requirements are that extreme.
They are. And they need sophisticated, often water-intensive cooling systems, which themselves rely on pumps and components that might use rare earth materials. So you have rapid depreciation, massive energy needs, complex cooling. It all means that any significant rise in hardware cost or any delay or disruption in the supply chain for chips or related components can immediately shatter the economic logic underpinning these sky-high AI valuations.
Okay, let's paint the scenario then. If this trade conflict, specifically the combination of high tariffs making everything more expensive and China's rare earth controls potentially restricting key components if the situation endures, say, into early 2026, just 6 months or so of serious friction, what does the concrete financial fallout look like for the tech sector?
The consequences could unfold pretty quickly, starting with physical limitations, actual hardware bottlenecks.
Meaning companies just can't get the gear they need.
Exactly. Shortages of processed rare earths, which, as we said, are needed not just inside some chips or magnets, but also potentially for advanced liquid cooling systems in these hyperdense data centers, could significantly delay the rollout of the next generation of huge AI supercomputing clusters. We're talking of projects like OpenAI's Stargate or xAI's Colossus, these massive multi-billion-dollar build-outs.
And lead times for the most advanced chips were already long, weren't they?
Already stretched, often 12 months or more. Add geopolitical restrictions on top of that, and you could see data center construction and expansion plans paralyzed for months, maybe longer. Companies simply can't deploy the capacity they promised to raise money to build.
Okay, so physical delays hit first,
Yeah.
and then the costs start hitting the balance sheet hard.
Right. Cost inflation becomes a massive hurdle, potentially collapsing the entire profit model for many AI ventures. Those high tariffs we discussed, the 145% on some components, could effectively double the import costs for GPUs, servers, maybe even lithium-ion batteries used for power backup.
Doubling the cost of the core infrastructure.
Potentially for components sourced from China.
Mm.
Analysts have tried to quantify this, suggesting it could add somewhere between $75 billion and $100 billion in unplanned expenses for AI data centers globally over the next 5 years.
Unplanned expenses on that scale.
When your entire business model and investment thesis are based on assumptions of rapid, efficient, low-cost scaling, that level of unexpected cost inflation is potentially lethal to profitability projections and future funding rounds.
So if the promised returns start to stall because of these physical bottlenecks and the soaring costs, what happens to investor confidence? That seems like the linchpin holding the froth up.
It vanishes. Confidence collapses the next stage, and it can happen incredibly quickly in tech cycles.
Hmm.
We have to remember, even before this geopolitical shock, sober analysts were already forecasting that something like 98% of current AI startups will ultimately fail within the next 5 years.
98%. That's a brutal failure rate.
It's typical of major tech shifts. Most ventures don't make it. Now, if the path to revenue is suddenly blocked or made vastly more expensive by hardware unavailability and cost inflation caused by trade wars, investors aren't going to wait around. They'll flee the sector en masse, looking for safer returns.
And that leads to
Not a slow, orderly correction, but likely a sudden liquidity crunch. Startups can't raise their next funding round. They run out of cash. Mass layoffs, bankruptcies. We could genuinely see the onset of a new AI winter.
Now, I have to push back slightly here. We're talking about huge, sophisticated U.S. companies like Microsoft, Google, Amazon, Meta. They're major players in AI infrastructure. They have complex, diversified global manufacturing bases. Is it really this trade war, this specific conflict, that's causing the fragility? Or are we just watching a necessary, maybe overdue correction in an obviously overheated sector that would have happened anyway, and the trade war is just the convenient trigger or excuse?
That's an excellent and fair point. It's almost certainly both, but they interact in a really destructive way.
Yeah.
Yes, the sector was arguably overheated. Valuations were stretched. A correction of some kind was probably inevitable.
Right.
But the geopolitical friction, specifically, the weaponization of controls by both the U.S. and China, acts as the massive external catalyst. It's the pin that pricks the bubble. It turns what might have been a slower, perhaps more painful, but manageable correction into potentially an immediate, violent burst. It forces the issue right now.
And the spillover effect into the broader market. If the AI sector, which has driven so much of the market gains, suddenly collapses,
The wider market impact could be enormous. Because the market has become so reliant on AI optimism, the sources we reviewed warn that the S&P 500 index could potentially lose up to 20% of its current valuation.
20% off the S&P 500 based on an AI downturn.
Yes, because the analysis suggests that a staggering 80% of the market gains in the S&P 500 during 2025 were directly or indirectly linked to the AI sector. Chip makers, cloud providers, software companies benefiting from the hype. If that engine stalls violently, it takes a huge chunk of the market down with it.
It really is the ultimate dark irony then, isn't it, in trying to secure their own technological futures, trying to kneecap a rival.
Both Washington and Beijing risk triggering a deep AI winter, born not of some fundamental flaw in the algorithms, but purely out of geopolitical overreach and the resulting supply chain chaos.
So the very pursuit of technological supremacy ends up threatening to trigger a global economic slowdown, potentially quite a severe one.
Precisely. It creates the conditions for stagflationary pressure. You have rising prices because of the tariffs acting as a tax, combined with constrained economic growth because a major market-driving investment sector collapses. It's a dangerous combination.
Okay, so we have this escalating economic confrontation, these weaponized controls hitting critical supply chains, threatening the AI boom. But there's another whole layer to this, isn't there? This entire conflict is now deeply entangled in a massive legal battle right here in the U.S.
That's right. It's not just playing out in trade negotiations or corporate boardrooms. It's landed squarely in the lap of the U.S. Supreme Court.
And this isn't just about the specifics of tariffs on certain goods. It goes right to the heart of presidential power, doesn't it?
Right.
About the constitutional limits on the executive branch's ability to wage this kind of economic war.
Exactly. The core legal question before the court is fundamental. Does the president have the authority under existing law to impose these kinds of sweeping, open-ended, potentially massive trade taxes on goods from specific countries without explicit specific approval from Congress for each action?
Because many of these expanded tariffs, especially the really high ones imposed recently, were justified using emergency power statutes, right? Not necessarily the standard trade law.
That's a key part of the legal challenge. The administration has often relied on laws like the IEPA, the International Emergency Economic Powers Act, to provide the legal basis for broad tariff actions, framing the trade relationship or specific imports as a national emergency.
IEPA. Okay, what was that law originally intended for? Was it meant for setting long-term trade policy?
Not really, according to the challenges in the lower courts that have ruled so far. IEEPA was enacted in the 1970s primarily to give the president authority to regulate international financial transactions and freeze foreign assets during specific declared national emergencies, think situations like hostage crises or responding to foreign aggression. It wasn't really envisioned as a tool for imposing broad import duties across vast sectors of the economy on an ongoing basis.
And the lower courts have agreed with that interpretation. They've been skeptical of using IEPA this way.
Very much so. Two separate lower federal courts have already ruled that the way these expansive tariffs were implemented, particularly relying on broad emergency justifications, actually exceeded the executive authority granted by Congress under IEPA.
What was their reasoning?
In essence, the court said that while IEPA grants significant power during genuine, typically short-term emergencies, it cannot be used as an open-ended substitute for Congress's core constitutional authority over international commerce and, crucially, the power to lay taxes and duties. One ruling explicitly stated that emergency powers are not a substitute for Congress.
That's a pretty direct statement on the separation of powers.
It is. It suggests the courts are trying to push back against what they see as an overreach of executive power into areas traditionally reserved for the legislative branch.
And this specific legal interpretation, this stricter reading of the president's emergency powers, becomes even more significant when we consider the broader context of recent Supreme Court decisions, right? Particularly around agency power.
Absolutely critical context. We have to remember the recent landmark overturning of the Chevron deference doctrine in the Loper-Bright case in 2024.
Right. Chevron deference basically meant courts would typically defer to a government agency's reasonable interpretation of an ambiguous law that Congress asked the agency to administer.
Exactly. For decades, that gave agencies, and by extension the executive branch, a lot of leeway in interpreting their powers. But Loper-Bright threw that out. Now, the Supreme Court has said courts should not defer to agencies. They should interpret the law themselves, using traditional tools of statutory interpretation.
So they'll read the laws more strictly, based on the text and original meaning.
That's the implication. In the context of trade law, this means statutes like IEPA or even Section 232, which deals with national security imports, are likely to be read much more strictly by the courts going forward. It makes it significantly harder for the executive branch to justify broad, sweeping tariff actions based on potentially ambiguous statutory language or claims of inherent emergency powers. The administration has to show clear authorization from Congress.
Okay. So this legal backdrop frames two very distinct possible futures, depending entirely on how the Supreme Court rules in this tariff case. Let's walk through those scenarios. Scenario A. The Supreme Court strikes down the broad tariffs. They agree with the lower courts that the executive overstepped its authority, particularly under IEPA. What happens then?
Okay, if the court strikes down these specific broad tariffs as unlawful, the most immediate economic effect would likely be a near-term disinflationary nudge.
Meaning prices might ease a bit.
Yes. Suddenly removing those massive import taxes, that potential 145% duty on EVs or steel, for example, would reduce cost pressures for importers. Some of that saving would likely be passed on, offering at least modest relief to retailers and consumers on affected goods. You'd probably also see a significant, immediate risk-on rally in the stock market, especially for companies heavily reliant on Chinese imports or supply chains.
Correct, some economic relief. But does the Supreme Court ruling on the legality of these specific tariffs actually end the underlying strategic competition? Does the trade war just stop?
Not at all. And this is crucial. A court ruling striking down tariffs imposed under, say, IEPA is essentially a policy reset, not a strategic retreat. It forces the administration to find a different legal tool. It doesn't change the underlying policy goal.
So the White House would just look for other ways to impose tariffs.
Most certainly. They would immediately look to retool their policy, likely relying on legal paths that the courts have generally found more acceptable or that have stronger procedural frameworks. The most obvious candidates are Section 301 of the Trade Act of 1974.
Section 301, that's the one managed by the U.S. Trade Representative, USTR, and deals with unfair trade practices, right? Like intellectual property theft or subsidies.
Exactly. Courts have generally given the USTR more leeway under Section 301, and in fact, previous tariffs under Lists 3 and 4A from the first trade war, which were based on Section 301, were largely upheld by courts as recently as September 2025. So that provides a potential avenue.
Okay. Any other options?
They might also try to reframe tariffs more narrowly under Section 232 of the Trade Expansion Act of 1962, which allows tariffs based on national security threats posed by specific imports, like steel or aluminum historically. While Chevron's demise might lead to stricter scrutiny even here, national security arguments have historically received significant deference from the courts.
So the bottom line for Scenario A is the U.S. probably still imposes tariffs, maybe slightly different ones, maybe justified differently, but they have to follow a more stringent, legally defensible process. The economic pressure likely continues, just through different channels.
That's the likely outcome. And here's the most critical strategic caveat for listeners to remember. Striking down U.S. tariffs does absolutely nothing to undo China's rare earth export controls.
Ah, right, because China's leverage isn't based on tariffs.
Exactly. China's entire rare earth playbook, that 0.1% rule, the licensing requirements, it relies on controls and administrative licensing decisions, not tariffs. It's completely unaffected by U.S. tariff levels or U.S. court rulings about U.S. presidential power. So the fundamental strategic reason for the U.S. and its allies to pursue friendshoring or onshoring of advanced chips and the entire rare earth magnet supply chain, that rationale persists unchanged regardless of the tariff price. The vulnerability remains.
Okay, that's a really important point. The controls operate independently of the tariffs. Now let's consider the alternative. Scenario B, the Supreme Court upholds the tariffs. They rule that the president does have broad authority, perhaps under IEPA or inherent powers, to use these sweeping tariffs as a tool of foreign policy or national security. What happens then?
If the tariffs are upheld, essentially blessing the broad use of executive power for trade restrictions, then the process of economic decoupling accelerates dramatically. And the immediate economic impact is that inflation likely gets much stickier.
Stickier inflation. Wow.
Because those high input costs from the tariffs remain embedded in the economy. That potential $1,200 to $1,500 annual cost per household we mentioned, that stays. Prices for a wide range of goods remain elevated. This outcome would severely complicate the Federal Reserve's job in trying to get inflation back down to its 2% target. It keeps alive the risk of higher for longer interest rates, which has its own negative consequences for growth and borrowing costs.
Okay, so inflation remains a bigger problem. How would corporations react if the highest court says these tariffs are legal and likely permanent?
The sources suggest this is the point where corporate strategy fundamentally shifts. The tentative China plus one strategy, where companies keep a major manufacturing base in China, but also start building some alternative capacity elsewhere, just in case.
Right, hedging their bets.
That likely transforms into a more decisive China or none approach for many critical supply chains. With legal uncertainty removed, corporations would see the high tariffs and the geopolitical risk as permanent features. They would stop hedging and make hard choices.
Meaning they accelerate investment outside of China.
Yes, aggressively. You'd see a massive acceleration of investment into building truly redundant capacity in places like Mexico, Vietnam, India, maybe Eastern Europe. Not just dipping a toe in the water, but building full-scale duplicate supply chains that can operate entirely independently of China. It becomes a strategic imperative for resilience.
And how would Beijing likely react to that, to seeing companies actively designing China out of their strategic supply chains?
The most probable reaction, according to the analysis, is that Beijing would double down on its own controls. They would likely tighten the screws further on their rare earth and permanent magnet export licensing. They might expand their unreliable entity lists to include more Western companies. They would use their leverage to push back.
So upholding the U.S. tariffs could ironically lead to more Chinese controls.
It's a feedback loop. A U.S. court decision upholding broad tariff powers would signal a permanent U.S. policy of containment, incentivizing China to use its own leverage more forcefully. This scenario explicitly accelerates the fracturing of the global economy into that two-block economic world we discussed earlier, one centered around the U.S. and its allies, the other around China and its partners.
So, in a way, the Supreme Court's decision, while hugely important legally and economically, might ultimately just determine the speed and the legal pathway of the fracture rather than preventing the fracture itself.
That seems to be the central takeaway from the analysis. Because the technology controls the chip bans, the rare earth restrictions are arguably more fundamental drivers of the split than the tariffs are.
Controls outrank tariffs in strategic importance.
That's the argument. Tariffs are painful, they're inflationary, they distort trade, but they primarily shape prices. Companies can often adapt, find workarounds, or pass on the cost. But export bans and licensing controls the U.S. blocking the sale of cutting-edge semiconductor manufacturing equipment, or China blocking the export of processed dysprosium needed for defense magnets. Those shape possibility. They determine what can and cannot be built, what technologies can be pursued. They directly impact national security capabilities.
And those controls are the real engine of this strategic competition, the real fulcrum of Trade War 2.0, regardless of what the Supreme Court decides about the legality of the tariff tax itself.
Exactly. The controls are where the core battle for technological supremacy and supply chain security is being fought. The tariff fight is hugely consequential for inflation and corporate costs, but the controls define the long-term strategic landscape.
Okay, so whether the Supreme Court strikes down the tariffs or upholds them, whether the controls bite harder sooner or later, it seems clear that this sustained level of confrontation, this Trade War 2.0, is already inflicting real economic damage, and the forecasts suggest it could get much worse. Let's try and quantify that damage. What does the economic damage report look like for both the U.S. and China, and for the wider global economy?
The estimates presented in the sources are frankly pretty grim. Economists modeling the potential impact, especially if those tariffs snap back to their full expanded levels, remember, up to 145% on the U.S. side, and potentially reciprocal Chinese tariffs reaching, say, 125% on key U.S. goods, the potential GDP losses are significant.
How significant?
For the U.S., the estimates suggest a potential hit of 1.8% off U.S. GDP over the next 12 months. For China, given its greater reliance on exports, the estimated impact is even larger, potentially 2.5% off China's GDP over the same period.
Okay, let's pause on that U.S. number. 1.8% off GDP. That sounds technical, but put that in context for us. What does that magnitude of loss actually feel like for the economy? Is that a recession?
It's definitely recessionary territory. A hit of 1.8% to GDP is huge. To give you some perspective, that's roughly equivalent to wiping out all the U.S. economic growth generated over the previous, say, 2 or 3 quarters combined. It wouldn't just be a slowdown. It would represent a measurable contraction of the economy.
And that contraction wouldn't just be confined to manufacturing, right? Even though the tariffs target goods.
No, the effects ripple outwards. It's driven partly by the direct impact of higher input costs hitting manufacturers, making them less competitive. It's driven by lower export volumes as retaliatory tariffs bite. But it also hits the service sector, logistics, transportation, finance, retail, all of which are deeply intertwined with trade flows and overall economic confidence. And, as we discussed, a major hit to the AI investment boom would have massive negative wealth effects, further dampening consumer spending and business investment across the board.
And speaking of consumers, the cost hits household budgets directly too, doesn't it? We touched on this, but let's reiterate the numbers.
Yes. Those tariffs, if fully implemented, act as a highly regressive, hidden tax on consumption. The sources consistently estimate that the average American household could see its annual expenses rise by somewhere between $1,200 and $1,500.
Where would people feel that most?
You'd see it pretty quickly in the prices of imported consumer electronics, clothing, furniture, toys, appliances, basically, a lot of the stuff you find in big box stores. Those goods could see price hikes anywhere from 10 to 30%, depending on the specific tariff rate and how much gets passed through. And crucially, this kind of inflation disproportionately hurts lower and middle income families who spend a larger percentage of their income on these types of goods.
So broad economic contraction, higher consumer prices, and we can't forget the specific sectors that get hammered, like agriculture. They were really hurt in the first trade war.
They are once again positioned as the immediate, localized losers. It's like revisiting the painful memories of 2018, 2019 all over again for many farmers. U.S. agricultural exports, particularly things like soybeans and pork, which were heavily reliant on the Chinese market, face massive potential declines if high retaliatory tariffs come back.
Do we have numbers on that?
Well, Soybean exports to China, which were once valued at around $14 billion annually pre-trade war, had already dropped significantly, maybe by 60% or more, during the peak of the first conflict. A return to that situation, or worse, would create severe economic stress, potential bankruptcies, and real financial hardship across the Midwest farming belts. It becomes a very painful, very visible consequence.
Okay, so significant pain points, slower overall growth, higher consumer costs, specific sectors like agriculture getting hit hard. But as you always say, in every major economic disruption, even painful ones, there are usually some parties, some sectors, some countries that actually gain because they're structurally positioned to benefit from the new rules of the game. Who are the potential, perhaps unexpected winners in this era of strategic fragmentation?
Right, it's not uniformly negative. The winners tend to be those who are positioned to meet the surging demand for diversification and resilience. There are a few key groups.
Okay, who's first?
First, you see benefits for domestic manufacturing in certain strategic sectors within the U.S. Things like steel, aluminum, maybe batteries, and definitely semiconductor fabs are seeing increased investment, partly driven by the tariffs making imports less competitive, but also significantly amplified by industrial policy incentives like the Cheats and Science Act. The Made in America push gets a real tailwind.
So specific U.S. industries benefit from the protectionism and subsidies. Who else?
Second, and perhaps the biggest winners geographically, are certain emerging economies that become the prime beneficiaries of that China plus one or China or none strategy we talked about.
Which countries are seeing the most benefit?
Multinational firms, desperate to de-risk their supply chains away from China, are accelerating their investments elsewhere. The sources highlight Vietnam as a major winner. Its exports to the U.S. were reportedly up something like 34% year-on-year recently, driven by electronics and apparel moving out of China. Mexico is also benefiting hugely from nearshoring, especially for goods destined for the U.S. market. And India is seeing massive new capital inflows, particularly in electronics assembly. Think about Apple rapidly scaling up iPhone production there to build redundancy outside its traditional Foxconn base in China.
So these countries capture the manufacturing activity that's leaving China.
They capture a significant chunk of it. It's not a simple lift and shift overnight, but the trend is clear and accelerating. Building these alternative hubs is now a core strategic priority for global firms.
Any other winners?
You could also point to defense and cybersecurity firms. Heightened geopolitical tension, unfortunately, almost always translates into larger, more consistent defense budgets globally. And the focus on economic warfare, intellectual property protection, and securing critical infrastructure means spending on both corporate and national cybersecurity solutions is likely to continue rising sharply.
Okay, so while the overall global growth rate might slow down entering that era of slowbalization, as some call it, where efficiency takes a backseat to resilience.
Right, growth is maybe slower, but supply chains are hopefully less prone to sudden disruption.
This conflict is fundamentally reshaping the geography of global production. It's making supply chains more complex, probably more costly overall, but the goal is to make them more resilient to geopolitical shocks.
That is precisely the long-term imperative driving corporate and government strategy now. The core realization, hammered home by the pandemic and now this escalating trade war, is that deep reliance on a single potential adversary for critical inputs, whether it's PPE, semiconductors, or rare earths, is simply an unacceptable national security risk.
And addressing that risk means building that alternative supply chain, particularly for the most critical inputs like rare earths.
Yes, going back to that mine-to-magnet supply chain outside China, as we said, it's a massive capital-intensive undertaking. It's that 5 to 7 year project, minimum, requiring huge government backing.
And just to reiterate, the focus needs to be on the bottleneck stages, right? Not just mining.
Absolutely critical. The subsidies, the policy support, the R&D funding, it has to be laser-focused on mastering and scaling up the complex, expensive, and environmentally challenging steps. The chemical separation and refining of the rare earth oxides, and the specialized manufacturing techniques for producing high-performance rare earth permanent magnets. That's where the West lost its capability, and that's where the strategic vulnerability lies. Simply finding more rocks in the ground isn't the solution.
This whole reshaping, this quest for resilience, this explicit division driven by controls, it really feels like it's cementing the architecture of a new kind of Cold War, doesn't it? But maybe one fought with economic tools instead of just military ones.
That's exactly how many of the sources are framing it. They argue that the world is rapidly and perhaps irreversibly fracturing into two distinct technospheres, two separate, competing technological and economic ecosystems that might become fundamentally incompatible over time.
Two technospheres. Okay, walk us through what those look like. What defines each sphere maybe by 2030?
On one side, you have what the sources often term the Western cloud. This sphere is dominated by U.S. and allied firms. Think NVIDIA, OpenAI, Microsoft, Google, ASML in the Netherlands, TSMC in Taiwan, Oracle, the Western financial system based on the dollar.
And its focus is on.
Its primary focus and competitive advantage lie in algorithms, cutting-edge chip design, sophisticated software ecosystems, cloud computing infrastructure, and complex financial systems. Its strength is largely in innovation speed, intellectual property, and financial depth. It controls the bits and the brains, you could say.
Okay, that's the Western cloud. What's the other sphere?
The other is termed the Eastern Grid. This sphere is led by China, with companies like Huawei, SMIC, China's top chip foundry, Baidu, CATL, the battery giant, and a vast network of state-linked infrastructure companies, often working closely with countries participating in the Belt and Road Initiative.
And its focus.
Its strength lies more in controlling the atoms, the raw materials like rare earths and processed minerals, the physical manufacturing hardware, battery technology, 5G infrastructure, and large-scale industrial production capacity. Its advantage is its command over physical production, supply chain logistics within its sphere, and sheer scale. It controls the grid and the guts.
So we have the cloud focusing on design and software, and the grid focusing on materials and hardware manufacturing. Will these two systems be able to interact?
The fear, and the trend suggested by the current controls, is that interoperability between these two systems may rapidly diminish, perhaps significantly by 2030. Standards diverge, data flows become restricted, technology platforms become walled off. We might see incompatible charging standards for EVs, different AI operating systems, separate semiconductor supply chains.
Which forces companies and even entire countries to make hard choices.
Exactly. They'll increasingly have to decide which digital industrial platform they want to operate primarily within. Aligning with one might mean losing access or facing restrictions in the other. It becomes a fundamental strategic alignment choice.
So the question really isn't whether we can fully decouple anymore. That train might have already left the station, driven by these strategic controls. The real question is how we manage the transition into these two potentially segregated, increasingly non-interoperable systems.
Two separate economic worlds competing for global influence, resources, and technological leadership. And critically, how we manage the fear that is driving this entire process. Yes, both sides, Washington and Beijing, seem to view this conflict increasingly as an existential struggle for their future economic survival and technological sovereignty. And when that level of fear takes hold, it naturally leads policymakers to prioritize national security, self-sufficiency, and resilience above all else, even above global economic efficiency or cooperation. That fear is the engine driving the strategic fragmentation we're witnessing. #NACGOutro.
Okay, let's try and synthesize this, try and bring it home for everyone listening. We started this deep dive by saying, this is Trade War 2.0. And I think what we've really seen as we've unpacked it is this fundamental shift, haven't we? It's moved from being a maybe conventional, if painful, trade war about tariffs on widgets and soybeans.
Right, about market share and deficits.
To becoming a much deeper, more fundamental strategic war. A war about critical inputs and maybe even competing ideologies or systems. It's minerals versus chips. It's code versus control.
I think that's right. And if there's one central realization that emerges from analyzing this complex mess, it's the principle of mutual vulnerability. It's stark.
Meaning both sides can hurt each other badly, but maybe can't land a knockout blow without hurting themselves just as much.
Exactly. The U.S. clearly has the leverage, through its control of key technologies and financial systems, to seriously cripple China's ability to produce the most advanced semiconductors and maybe stay at the absolute cutting edge of AI model development. That power is real.
But
Conversely, China can absolutely weaponize its dominance in critical mineral processing, especially rare earths and magnets, to potentially cripple America's high-tech industrial base, its defense production capabilities, and even put roadblocks in the way of the global energy transition, which relies heavily on those materials. That power is also very real.
So neither side can achieve a decisive win in this economic conflict without inflicting massive, potentially unacceptable self-harm in the process.
It certainly seems that way. The interdependence, even as both sides try to reduce it, is still profound enough to guarantee mutual pain if the conflict escalates uncontrollably.
And this situation, this uncomfortable reality, is therefore defining this new era. an era characterized by what you called strategic fragmentation.
Yes. It seems to be a state of, perhaps, permanent economic coexistence without genuine cooperation, at least between the two main blocs. Every major economic decision, every investment, every supply chain choice is now being viewed, first and foremost, through a geopolitical and national security lens. Efficiency and cost are secondary considerations now.
Which leads us, I think, to the final provocative thought we want to leave with you, the listener, to really consider after hearing all this.
If we accept, just for the sake of argument, that the economic pain we've discussed, the inflation, the supply chain delays, the market volatility, the slower growth, while serious, is potentially measurable and maybe even reversible over time.
Okay.
But if we also accept that the underlying geopolitical competition between these two titans, the U.S. and China, is now structural, deep-seated, and likely permanent for the foreseeable future.
Right, that the rivalry itself isn't going away.
Then what is the preferred or perhaps the least bad outcome? Does the world, do we, in fact, implicitly prefer the cold peace of a prolonged, costly, inflationary trade war, this strategic fragmentation, even if it guarantees stickier inflation and limits overall global growth?
Compared to what alternative?
Compared to the catastrophic alternative of this rivalry, escalating beyond economic means into actual kinetic conflict? Is the economic pain the price we pay to avoid something far worse?
That's a heavy question. Is the current state, however damaging economically, a way of managing the deeper conflict?
It's something to ponder. The ultimate challenge now, it seems, is not whether we can fully decouple, because as we've discussed, that trajectory seems largely set by the strategic controls already in place. The decoupling is happening, perhaps at different speeds in different sectors.
So the real challenge is?
The real challenge is whether the leaders in Washington and Beijing, and indeed globally, can somehow manage this process. Can they transform this potent cocktail of mutual economic fear and strategic rivalry into some form of collective wisdom, or at least stable management?
Before this structural economic confrontation spirals completely out of control and forces us, perhaps unintentionally, down the path towards a far more direct and infinitely more dangerous form of conflict.
That seems to be the core dilemma. Because the stakes here aren't just about market share or GDP points anymore. The stakes are the foundational atoms of our technology, the algorithms that will shape our future, and perhaps the stability of the entire global order itself.
A profound and somewhat sobering point to end on. Thank you for walking us through that complexity.
Thank you. The critical issue to understand. And thank you all for joining us for this deep dive into the strategic fragmentation of the global economy.